Imagine a startup touting AI-powered solutions that doubled revenue, except the company can't show what AI means, who vets the models, or whether the vendor they rely on is one contract away from collapse. Sounds unlikely? That kind of vagueness is now a red flag that can cost investors millions and founders their next round. Stay with me. In the next 12 minutes, you'll learn the 7 red flags every investor and founder should spot in AI, tech, and ESG disclosures. Why each omission matters for governance and capital allocation, and exact rewrite templates you can drop into your next shareholder letter to make claims audit-ready. Investors and regulators are no longer satisfied with slogans. The SEC flagged AI disclosures as a priority in mid-2024. Investors report they want clearer ROI and governance details, and scholars are calling for pre- and post-mitigation safety reporting for material AI systems. But here's the thing. Most shareholder letters and memos still read like marketing copy. That's a problem, because vague disclosures hide governance gaps that change risk and valuation. This is educational only, not legal, tax, or investment advice. Check company filings and consult counsel for material disclosure or regulatory questions. By the end, you'll have a 7-point checklist, what each omission implies for governance and capital allocation, and ready-to-use sentence-level templates to turn mush into investor-grade language. Later, there will be a live teardown where 3 real shareholder paragraphs get rewritten in front of an audience. Want those templates now? Keep listening. Boilerplate is the single biggest giveaway of weak disclosure. A paragraph that reads, "We use AI to enhance customer experience and drive efficiencies," with no numbers, timelines, or named owners, is a red flag. Why? Because it hides 2 things: execution risk and lack of internal controls. Investors want measurable claims: how much CapEx or OpEx was invested, what productivity uplift you expect, and by when. In 2024 and 2025, only around 37% of investors thought companies disclosed enough on AI strategy, and about 42% wanted clearer disclosure on investments and returns. So when you see marketing speak, ask, what's the baseline? What's the target? What's the time horizon? Without those, claims are unverifiable and inflate valuation expectations. The omission implies investors will treat the program as exploratory, often applying higher risk discounts, asking for covenant protections, or slowing commitment. For founders, that can translate to tougher term sheets. Here is a rewrite you can use. Define the term AI systems as production models used to automate customer support, routing, and fraud detection. State scope. Customer support routing will target a 25% reduction in average handle time, baseline 8 minutes as of the last quarter, by Q4 of the next year. Investment: $3.2 million incremental CapEx in the fiscal year, and $900,000 annualized OpEx thereafter. Owner: the Vice President of Engineering reports quarterly KPIs to the CTO and the Audit Committee. Companies often use AI like it's one thing. It's not. Is it narrow decision trees, pre-trained large language models, or proprietary models trained on sensitive customer data? The SEC has emphasized that tailored, company-specific definitions help avoid misleading impressions. Different classes of AI carry different legal, operational, and reputational risks. A vendor-hosted, pre-trained model involves vendor risk and data training concerns. An internally trained model implies different intellectual property and audit needs. Not defining scope is like saying you have software without clarifying whether it's accounting software or flight control systems. Companies that describe AI specifically enable investors to map risk to materiality thresholds. Without it, you get hidden tail risk, the kind that shows up at the wrong time. Ask what systems are in scope, what data they use, and what decisions they influence. A practical disclosure reads, for disclosure purposes, AI means models that input customer transaction and behavioral data to produce automated, production-facing decisions. Material use cases in scope include automated credit decisions affecting roughly 18% of revenue, customer support routing, and dynamic pricing for B2B contracts exceeding $50,000 in annual recurring revenue. Systems excluded. Internal research prototypes not deployed to production. Many filings now mention board oversight of AI, but until 2025, only about 31% of large firms explicitly disclosed some level of board oversight. That matters because boards and named committees are the control mechanism investors rely on for escalation and accountability. If a memo says management oversees AI, but there's no named executive sponsor, no committee, and no escalation thresholds, that's a red flag. It suggests governance leaks. Who signs off on deployments that change revenue recognition? Who reviews model change logs? Who gets notified when a model materially degrades or causes a regulatory complaint? The omission implies higher governance and tail risk, often leading investors to demand board-level covenants, extra monitoring reports, or even seats for certain investors. A strong disclosure reads: Oversight. The Audit Committee receives quarterly AI risk reports prepared by the head of machine learning governance. The board receives an annual summary and immediate notification if any AI system materially affects financial statements, customer safety, regulatory compliance, or results in a loss greater than $250,000. Escalation trigger. Automated model drift above a 15% threshold, or any third-party vendor outage lasting more than 72 hours. Vendor concentration and data provenance are first-class risks. If your company depends on one cloud provider, a single model vendor, or third-party data with no audit rights, that's systemic counterparty risk. A single vendor dependency can turn a model outage into a material revenue event. Worse, if your training data includes licensed third-party data sets without clear rights or provenance, you may face intellectual property or regulatory exposure. Investors want to know vendor names in high-level summaries, concentration metrics, and whether the company has audit rights or model provenance documentation. The omission implies potential operational shocks, unexpected regulatory fines, or forced rebuilds that create surprise capital needs. A useful vendor disclosure looks like this. Vendor and data summary. Primary cloud provider accounts for 72% of compute in a single region. Primary model vendor provides inference APIs for 40% of production traffic. Data provenance. Customer transaction data stored in-house. A third-party behavioral dataset comprises about 12% of training data under a renewable license through 2027. Audit rights. Contractual audit and deletion rights exist with one vendor. No deletion rights exist with another. Mitigation plan. Phased sunset of the vendor without deletion rights by the second quarter of next year. Leading practice recommends pre- and post-mitigation safety evaluations for material AI systems. When disclosures omit testing methodology, sample sizes, or who performed the testing, they're weak. Without baseline and post-mitigation test results, investors can't assess whether a model is safe, accurate, or biased. That's not just reputational, it's financial. Look for statements like, "We conducted A/B tests on 10,000 anonymized cases and reduced false positives from 6.8% to 2.1% after calibration, validated by an independent third-party auditor." Silence or vague claims like models were tested extensively are red flags. The omission implies hidden model failure modes, lack of auditability, and potential urgent remediation spending. A robust testing disclosure might state, pre-deployment internal unit tests and a 10,000 case holdout validation showed a baseline false positive rate of 6.8% and precision of 0.84. Post-mitigation calibration reduced the false positive rate to 2.1% and increased precision to 0.91. Results were independently verified by a third-party auditor on March 8. Production inputs and outputs are retained for 180 days for audit with tamper-evident hashing. A claim that AI will drive efficiencies is not enough. Investors want quantified financial assumptions. How much was spent, expected timeline to payback, what KPIs move, and by how much. Failure to quantify often means the project is still a pilot or the company is uncertain about economics.